Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I'd like to welcome my good friend, Glenn Welling. Thank you, Glenn, for joining me on our Fortuna Advisors podcast, Create More Value. Glenn is founder and chief investment officer of Engaged Capital, an activist fund that invests in small and mid-cap public companies. He is also currently on the board of BRC Inc. and was previously on the board of NCR Corporation, the Heinz Celestial Group, TiVo Corporation, and other public companies. Before founding Engaged Capital, Glenn was a principal and managing director at Relational Investors, a $6 billion activist fund. And before that, Glenn was actually my boss in investment banking at Credit Suisse, where he was co-head of the strategic finance group. He also worked at Holt Value Associates, Value Add, A.T. Kearney, and Maricon. He brings much experience to this discussion. We are also speaking with Paul Clancy about what it's like to be inside a company that is dealing with an activist shareholder. But here we turn the tables to ask Glenn about the view from the activist seat. Welcome, Glenn. I guess first, tell us about how you transitioned from being a consultant to a banker and to then being an investor, or what's common between these different sort of career paths and what's different.
Well, thanks for having me, Greg. It's a pleasure to be here, and hopefully I can defend the activist position from whatever comments came out in your conversation with Paul. Look, I've basically done the same thing my entire career, which is to help boards and management teams of public companies figure out how to get their stock up. I started doing this as a strategy consultant right out of school. I then built a decision support software company with a few partners to automate that work. We actually sold that company a couple times, the last time to Credit Suisse First Boston, which is how I ended up as banker and eventually running all of the bank's advisory businesses and clearly where we got to work together. And then I got recruited out of Credit Suisse to join Relational Investors. Relational was one of the country's first activist investing firms, where I had the opportunity to be partners with really activist investing pioneers, Ralph Whitworth and David Batchelder. And then lastly, when it became apparent that too much capital was chasing too few opportunities in the large and mega cap universe, I left to launch Engaged with the goal of bringing large cap quality activist insights into the small mid cap space, right? That's why we launched Engaged. We'd all gotten too big to focus where we all started, which was helping small mid-cap companies figure out how to drive more value for their shareholders, and I decided to go back and do that. I guess the difference between my role as a consultant or a banker versus an investor is that as an investor, I have a carrot and a stick. And as you know, as an advisor or a banker, you only have a carrot, right? If clients don't want to execute on the good advice you're providing, they can choose not to. It was frustrating for me often in the banking and the consulting role that we'd bring ideas for changes that we know would create billions of dollars of value, and for uneconomic reasons, you'd see managers make decisions that didn't necessarily correlate with shareholder value. And so the nice part of being investor, as being, one of the largest shareholders in our portfolio companies, and often a member of the board, is we don't just have that carrot. If in fact you make this decision, you will create a lot of wealth for shareholders and yourself. But we also have a stick. And that makes sure that we're able to get the value creation out of our investments.
It's funny, several decades ago when I was working inside of a large public company, I remember we always thought of the CEO as the one person who didn't have to take orders from anybody.
Well, he's supposed to be taking orders from his board, right?
Yeah.
And,
right.
the problem in a lot of public companies is you have this principal agent issue. and there aren't people in the boardroom that are spending the amount of time that they should be, and really overseeing management and governing the company. And so by bringing, what we like to do is bring an owner's perspective into the boardroom and to hopefully close that gap.
Mhm, mhm. It's a really interesting job you have. I mean, you must have, you know, endless stories you can tell about things you've seen and witnessed. But what are some of the more interesting activist situations that you've been exposed to? I mean, I'm just curious what really spurs your interest, given all of what you've seen.
Yeah, so we joke here every day that we're going to write a book at some point in the future when we're done, because you can't write it while you're still doing this work.
Mhm.
But the stuff we see is pretty amazing, and I'll happy to talk through some of those examples, and I might even give some company names. So, but actually, everything we do is interesting, right? That's what I'd say. You know, Everything that we invest in has some component of change. And so if you're a student of strategy and value creation and behavioral change, every investment we make is about changing strategy or operations or organizations and getting people to change behavior. And so to me, kind of everything we do is pretty fascinating. It's why I love my job. We have no idea when we get up in the morning what's going to transpire in one of the 8 or 10 names that we have in our portfolio. Um, and so, we've had a pretty good hit rate of the investments we make. We generate, good returns. Um, and so, I'd tell you some of the ones that are the most interesting are probably the ones where you don't generate the returns.
Mm.
But we'll focus on kind of generally like what do we see and why are these companies getting to these places that they need some type of a catalyst for change. So let's start with a company in our current portfolio that I think everybody on the podcast probably knows pretty well, Shake Shack. I find this one really interesting because it's such an iconic brand, and the fact that there was, actually still is, because we're very early in the process, so much operating performance improvements, right? In such an iconic and perceived to be really well run brand, it was really amazing to me when we first got involved, 12 to 18 months ago. And so, um, look, I think about, and I think you and I probably think about these things pretty similarly. I think about businesses in terms of two dimensions. How do they compete in the product markets where they compete for customers? And how do they compete in the capital markets where they compete for shareholders? And all of our customer work on Shack said, and by the way, on the company's top line data, their average unit volumes, how many dollars of sales that they actually produce in each of the stores, told the same story, which is that customers love the food, they love the product, and they love the hospitality in the restaurant. And that's resulted in these very high AAVs. Shake Shack does about $4 million of revenue per store, which is on the higher end of the spectrum for QSR restaurants or fast casual restaurants. However, when you turn to the capital markets, when we got involved, kind of 15 to 18 months ago, the share price had halved. And many of the investors that we spoke to who invest in the restaurant space said the company was uninvestable because the team didn't understand the operational improvement opportunities that were in front of them, and were in fact, the company was actually telling investors, if you don't like what we were doing, go invest someplace else. And so, I learned in my consulting years that I can't fix a bad business, but I can fix a bad valuation of a good business. And it was clear that's what we had here. Fixing the valuation was a matter of fixing the company's four-wall restaurant margins and lowering the cost to build stores to improve their cash-on-cash returns. And so it was fascinating to me that you had like an iconic restaurateur in Danny Meyer who developed this concept, hadn't realized how big the opportunity was to fix operations. And what we learned in our diligence, and like this goes back to our time at Credit Suisse together, what we learned is that Danny had created this hot dog stand in Madison Square Park right outside our offices. right? We used to look outside the window and see these 2-hour lines to go get a hot dog for lunch. None of us ever had any time, right? We're hardworking investment bankers. We never had any time to go eat the food because we couldn't wait 2 hours online. And it was actually done as a way to raise money to renovate the park. But it was so successful, and I give Danny and Randy Garuti, who ended up being the CEO, a lot of credit for saying, "Hey, let's turn this into something more than just a small hot dog stand." And so that's what they did, right? They decided to roll the concept out, but they staffed the company with fine dining executives from Danny's restaurant business. So, as they scaled, the team didn't know what to do. And so they made it up, and they never added any directors on the board or any executives with quick service or fast casual restaurant experience.
Hmm.
And as a result, as the company scaled, margins and returns suffered, but the customer is still really happy with the product. The
Mhm.
shareholders weren't happy with how much money the company was making and how much cash they were generating and what the returns are on the cash that was being invested. So we got involved to fix that. And by working with Danny and the board, we started with the board. We added 2 directors to the board with QSR experience: the former CFO of Domino's, the former COO of Panera and Dairy Queen. We convinced them to hire operational consultants. We had identified opportunities to improve margins 800 basis points. They moved on from their COO, began a search for a new operating executive. And then a few months later, the CEO retired. Randy realized that, hey, he'd been there for 20 years and they needed a different skill set to take the company forward. And they announced Rob Lynch, Papa John's CEO, who'd spent most of his career in the QSR industry, was going to join the firm. And Rob will be great. He understands how to scale a QSR business, and I expect to see that at Shack. All this has gotten the stock re-rated as investors now see the path to performance improvements that they certainly didn't see a year ago. And so I think over the next couple of years, you'll see hundreds of basis points of improvement in margins and cash and cash returns moving back into the 30% range. And so, that's what we do. We typically do it in a very constructive fashion. If it sounds like private equity, it is. We just happen to be doing it in companies in the public markets where we own a minority of the business, but a large enough stake, in this case, 8% of the company, to really have the influence, to help drive these changes.
Yeah, that last point is actually interesting. One of the kind of lost benefits in the public dialogue about activist investors is, the distinction versus private equity or just generally privately owned companies is, when you create a big improvement, 85, 90, 95% of that improvement benefits other shareholders. You're just keeping your share of it. And so as far as saying, you're doing something, noble for the economy and for society is, there's that benefit too that often gets ignored.
Yeah, we try to remind management teams when we get there. I always say that we when we arrive, nobody ever wants us there,
Mm.
right? It's you get used to that sense of rejection. But once we've been there for 90 days, nobody ever wants us to leave because we're bringing so much insight and so much value from outside the room or inside the room that they're not getting. Most boards don't have big analyst teams constantly doing work and consumer surveys and talking to peers and competitors and suppliers and customers. And so, what we know when we're walking into the room is a lot of information that the directors probably don't have insight into.
Mhm.
And so, yes, we're also educating a lot of the shareholder base. I mean, to your point, if we make money, the entire shareholder base is making money, and it's an important point. Even though we don't own the whole company like private equity, it benefits obviously every shareholder.
Yeah. So in that example, we had a good business, great product,
Yep.
great service, not great sort of efficiency and returns on capital and so forth. So it wasn't performing as well as it could be, but it was a great business. There are lots of companies out there like that, right? I mean, I would almost say most companies out there are like that, right? They've got a pretty good idea of how to deliver value for their customer, but they don't have a lot of success at turning that into creating real value for the shareholders. But that's obviously not enough to attract you into a company. What are some of the other things that attract an activist? What do you look for?
Yeah. So look, so the first thing I would say is every activist is different.
Mhm.
And
Good point.
I'd start with that. And when executives and directors ask me for advice, I get calls from friends of mine who are running companies who are dealing with activists, on a fairly regular basis. And I always tell them the first thing you need to do is know your activist, right? Because they're all shapes and sizes of activism. There's
Mhm.
operational activism, which is what we do. There's financial activism. There's ESG activism, right? And so
Mhm.
you really need to understand who is the investor that's in there that wants to play a role in fixing your valuation, right? So the
Mhm.
first thing is none of us are there most likely, right? Unless the company's underperforming.
Mhm.
Right. So the first thing we all look for, I think, is stock price underperformance on an absolute and or relative basis to peers or the index. Right. So that is unquestionably the first thing that all of us are looking for. If the company's performing well, we're probably not going to be there. Right.
Mhm.
Second thing, and again, this depends on who your activist is kind of glaring operational, financial, or organizational issues, right? Massive cost structure problems, let's call it materially lower gross margins or profitability versus peers, materially lower multiples versus peers, lower great growth rates versus peers, material higher working capital versus peers, track records of poor capital allocation, failed succession planning on the organizational side. All of those issues, we're looking for a reason that the company is underperforming that we can really understand. And then lastly, we need a path to solve these problems, like that we understand how to solve them and that there's a path to solve it through negotiations with the board, through internal or external pressure, through a campaign appealing to shareholders like a proxy contest,
Mhm.
right? We need to understand what changes are going to create value. We need to know there's upside, and then we need to know that there's a path to be able to get there. Um, and so, a lot of the companies we walk into, they suffer from what I call the ready, aim, aim, aim behavior, right? Like it's not like it's when we walk in, it's not that we're always bringing new insights. I think like for example, at Shack, I think we brought new insights, but at a lot of companies we walk in, the management and the board often know what needs to happen. They've just not been willing to make those really tough decisions. And that's what our job tends to be is to really kind of force them to pull the trigger on these tough decisions. And there was an investment we made a few years ago in the um, weight loss space called MetaFast that kind of had
Mhm.
all of this kind of embodied in one. And I'll spend some time. Happy to kind of spend some time talking about that so you can kind of see how it all comes together. In one company.
Yeah. Before we get to that, one point you made is an interesting one. You talked about margins being low, gross margins. And when you look from the outside and you look at a company that maybe is underperforming their peers on gross margin, that could be because of efficiency problems. It could be because of pricing problems. It could be because the products or services are not good enough and don't have the pricing power. And maybe in that latter case, it's not as attractive of an opportunity for you as if it's a pricing problem or a cost management problem. How do you tell the difference? How do you make sure that the products and services are actually good enough to put your capital behind it?
So that is the core of our research, right? Is we when you run a concentrated portfolio, right? We run a portfolio of 6 to 10 names. Like you need to get everything right, and when you don't get it right, it needs to be not a detractor. Like you need to be exiting it, pretty close to break even. And so diligence and deep research, including customer research, is really critical. We invest in a lot of companies that have weak gross margins, and um, our job is to make sure number one, this is a really good business, and number two, that whatever's holding the valuation back, the capital markets part of the mental mindset I talked about earlier,
Mhm.
is fixable. And so the diligence that we do in those cases is we do a lot of customer diligence. So we'll do customer surveys, we'll meet with customers, we'll talk to lots of customers. We're investing in a software company right now. They haven't raised prices in 12 years. Their margins are less than half where all the peers are.
Mm-hmm.
And part of that is pricing.
Mm-hmm.
Part of it is they've taken on lots of science projects over the years that have cost them a lot of money and haven't resulted in revenue. And
Mm-hmm.
so when you get control of capital allocation and you get control of pricing, and you look at the fact that they haven't priced and they've been spending a lot of money, you can understand why gross margins are where they are, and there's a direct line to fix them. What we have to do is make sure we avoid the situations that you identified at kind of
Mm-hmm.
the latter part of your conversation, which is those companies that have low margins, either because their products are inferior and or because they don't have pricing power.
Yeah, yeah. I mean, the speaking directly to customers makes so much sense. I'm surprised sometimes at how little time some of the senior executives at our clients spend actually speaking to actual customers rather than just others internally.
Yeah, I mean, one of the things that boards don't do is they tend not to go outside of the boardroom and do
Mm-hmm.
work. And so when we walk into a boardroom, we make an investment. Like I have a team as a director, I have a team of people behind me that are constantly doing work. So we tend to be more educated than any of the directors. But I mean, we do a lot of customer work because the reality is if the customers don't love the products, it's harder to fix the valuation issues, right? And
Mm-hmm.
so
Mm-hmm.
I mentioned Medifast earlier. Medifast is a nutrition and weight loss business, right? Food replacement. And we actually put 8 people on the program before we invested in the company. So not only did we do customer interviews, not only did we do survey work, but we actually put people on the program for anywhere between 4 weeks and 6 months before we made an investment. And what we found in that period of time was that every single person lost somewhere between 10 and 80 pounds, which was consistent with all of our customer work that said, oh, wow, people that can't lose weight elsewhere are able to lose weight on this
Mm-hmm.
on this plan. And that kind of gave us the confidence to say, okay, now we can go in and fix all the other issues that the company had. But we were very confident that the product was as good as anything else out there.
Mm-hmm. Mm-hmm. One other thing you said a minute ago was ready, aim, 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 which I thought was great. Um, I frequently find when I'm explaining what a company needs to do to improve performance that they yes me to death. We know that already. Of course, we know that, but yet they're not doing it. I get that you have a carrot and a stick, which makes it a little bit more effective. But how do you get them to see the light? How do you get them to take the action? What are the steps involved there that they're not getting on their own?
So, look, you your frustration was my frustration, right? As an advisor or a consultant, it's
Mm-hmm.
why I do like the role that I have now. Um, it starts with the same things that we worked on in consulting and banking, which is an irrefutable fact base,
Mm-hmm.
and so really strong arguments are where it has to start. We when we come in to any of these businesses, we come in with a very objective view. The only reason we're there is to fix the business to make money for shareholders. Right? There's nothing personal for us. What you tend to get, and I think the reason whether you get it as an advisor or as an investor, is you get that resistance because people don't want to admit that they made mistakes. Number
Mm-hmm.
one, and then number two, the ego kind of takes over. If you're a chairman or a CEO, like you're going to have some amount of ego, and you don't want to admit that, hey, like somebody else could bring me ideas that I don't have internally. I've been running this business for X number of years.
Mm-hmm.
And so it starts with irrefutable fact base. And then it starts, and then it moves, in my view, to compensation. And so, I learned a long time ago that people do what they get paid to do.
Mm-hmm.
And so we chair or sit on every compensation committee of every company we invest in where we're on the board or where we put people on the board. And that enables us to make sure that compensation is aligned with creating value and with driving the behavior that we're trying to drive out of the management team, whether that be growth or profitability or returns or cash flow, whatever it might be. Like, people figure out how to get paid.
Hmm.
And so you want to make sure that you've got compensation aligned. And after that, which are your carrots, right? Only then do you need to use a stick,
Hmm.
right? Which is the threat of replacing somebody, the threat of a proxy contest, whatever it may be.
Hmm.
But we have lots of levers and tools in order to drive behavior. Um, but what we've found is that the combination of really good data and a compensation scheme that pays people to drive value and change behavior is really, 90% of the time,
Hmm.
what does it. And them knowing that we have a stick, we rarely have to use it.
Hmm. So I have two final questions that kind of go together. The first one is, what either strategic or tactical actions should a company take in order to try to keep activists away? What are what should they be doing if they're worried about you knocking on their door? What kind of things should they be doing? And not just you, but more generally, activists at large.
Yeah,
how should they be
so
looking at themselves to be sure they're checking all the boxes or not checking all the boxes?
look, I would tell them that the best defense is a good offense. Um, so what does that mean? That means get your stock price up, make the hard decisions that we're going to push you to make, so that we don't show up. Right? That's absolutely number one.
Hmm.
Um, and then number two, when an activist does show up, go engage. Go engage with the activist. We're investors,
Hmm.
and the likelihood is we're one of your largest investors. And further, it's likely that that activist has been around for a while and they have a pretty good track record of helping companies create value. Otherwise, they wouldn't still be in business,
Hmm.
right? Our business is pretty brutal that way. If you don't generate good returns, capital tends to leave, and you tend not to be in business. So that means that if someone's shown up, they probably have a pretty good track record of creating value. It's also probable that they've met with many of your existing shareholders or the active ones that may be in your shareholder register. So it's likely that they're sitting there making these recommendations and that they're aligned with the rest of the shareholder base.
Hmm. Hmm.
And don't lose sight of the fact that investors made a decision to invest a large amount of money into your company, and that they have a thesis and a reason for doing that. And so you owe it to them and to yourselves and to your shareholders to listen and see what their investment thesis is all about. That's the one thing that when management teams take it personally, they kind of they lose the forest through the trees. And that really, like, as long as it's a long shareholder and not a short, we should be on the same page, because
Hmm.
all we're trying to do is help you find ways to create more value for your shareholders. The activist only makes money if the rest of the shareholders make money.
Hmm.
And so for us, it's not about ego, right? It's about making money. And this is a really, really important point because of what I talked about earlier. Like, we don't take things personally, but management teams do. And so my
Hmm.
best piece of advice is check your ego at the door, listen with an open mind. We don't have a lock on good ideas. Feel free to debate us, but, like, leverage the data that comes in from the activists. And if they have good ideas, make them your own. I always tell management teams, like, I don't need credit. I'm just here to make money.
Hmm.
I'm very happy if you take 100% of the credit.
Hmm. Yeah, you rolled right into my final question, which was how people should react when an activist does show up, which is good. Any funny stories or about things that have happened in that situation where you had a first conversation with management? And you can, feel free to do this part on a no name basis if you prefer.
So yeah, I'll tell you two that come to mind very quickly. So we invested in a name probably 7 or 8 years ago, and it was pretty contentious. And most of our investors are not contentious. Nobody ever wants us there, but we get to constructive pretty quickly. And this was a little contentious, and the chairman of the board. Anyway, I got into the boardroom, and the chairman of the board wasn't happy about that. I wasn't happy with the way it happened, and so the first thing I do whenever I enter a board is I basically fly around the country and I meet with every director in person. We go to breakfast or lunch or dinner or drinks or go play golf. I want to get to know them. We're going to be working together in the boardroom. Typically, when we come in, we're coming in with a little bit of tension, and people are wondering, how's this going to work out with an activist investor in the room? Do they have horns? Are they evil? And so I want to just level set everything and help people understand who I am and what we do and why we do it and what our views are on the company. I want to hear them out. I want to understand their views. And so I call the chairman, and I'm meeting with each of the directors, and the chairman won't return my phone call. He won't return my phone call. So I call one of the other directors, and I was like, hey, I can't get the chairman to call me back. And they're like, yeah, he won't talk to you. I'm like, well, we're going to be in the boardroom together. They're like, yeah, he's not going to talk to you. He's really upset, and he's not going to talk to you. And so this went on for 2 or 3 months. And then we kind of sat in a board meeting together, and you realized, wait, he's actually, again, this is the 90-day rule for me, right? And 90 days there, people don't want us to leave. You realize, actually, he's got a bunch of good ideas, and I understand why they're here. And this is now somebody that fast forward, it flipped very quickly, but fast forward 5 or 6 years, someone I talk to pretty regularly. We're friendly. We're talking about using him on other boards. He's invited us into other situations. He's done reference checks for us, right? And so it flips fairly quickly. But I'll give you one more that I think the listeners won't believe. We're invested in this business located in Baltimore, and so I fly out, and typically, when we have tough conversations, I want to do them face to face in a casual environment. And so I know I'm going to need to have a conversation with the CEO, who's the brother of the founder, about changing the board, and then, by the way, changing out him as the CEO, changing most of the management team, and making a lot of changes to this business. And the board is made up of the brother of the founder. The founder's passed away. The founder's two best friends from the Vietnam War, two war buddies. The founder's next door neighbor, the brothers, the new CEO, his next door neighbor, the daughter of the founder, the company's general counsel, and my two favorite directors, the family's priest and the family's nun. And by the way, the only thing they were missing was a rabbi, and it would have been a real joke, but this is not a joke. This was the board of a $400 million public company. And so I didn't want to go to a proxy contest because we think they're a waste of time and money. And if we can avoid it, we're going to avoid it at all costs. We've made 45 investments over the last 11 years, and we've only had 3 proxy contests, and I haven't had one in, I think, 7 years, right? So hopefully I'll never have to run another one. And so I go to Baltimore, we sit down for dinner, the CEO and the CFO and myself, and start talking about why we need to change the board. And the founder's brother has been an executive at a well-known big public company. I'm like, you understand that this is not normal, right? And that you have nobody in the boardroom that's ever worked in the industry that the company's in, never actually worked in industry, and that everybody's like an insider. And so we need to replace the majority of the board. And he said, okay. He goes, I don't disagree with you. I hear you. Again, this is another situation, right? They knew. They just need someone to force it because it's too hard given how close they are to the situation. And so he says, where do you want to start? And I said, all right, let's start with the easy ones. Let's start with the priest and the nun. And the CFO looks at me and he goes, all right, He goes, we can do that. He goes, but can they at least pray for us? And I said, absolutely, but they don't need to be in the boardroom to do that. And I go, so let's agree that we need to replace those two. Now let's move on to the harder ones. But it's just you get these just crazy situations. I mean, it's a public company board with fiduciary duty to shareholders. No surprise the stock hadn't moved in 3 years and the top line was shrinking, right? But you had a board that wasn't really a board and nobody was governing the business. So anyway, those are just a couple.
Oh, that's really great. Well, we're going to have to wrap up there. I want to really thank you a lot for coming on, Glenn. I think this has been great. Really appreciate you sharing all of your experience and your insights. Any final words you'd like to say?
No, it's been a pleasure talking with you, and I wish we got a chance to work together again.
Yeah, well, maybe we will. Who knows? You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.